Every year, millions of Americans follow the same standard advice. Max out the 401k, take the tax break now, let it grow, retire comfortably. For most of the country, that guidance is sound. It is repeated by financial planners, embedded in employer benefit materials, and treated as settled wisdom. For residents of New York, and particularly those in New York City, acting on it without understanding what happens at withdrawal can result in tens of thousands of dollars in retirement taxes that most financial guidance never addresses. The reason is not mismanagement. Generic advice rarely accounts for where people actually live. The 401k originated in the Revenue Act of 1978 as a relatively obscure provision within a larger piece of tax legislation. The structure it created was straightforward. Contribute pre-tax dollars, allow the money to grow without taxation, and pay ordinary income tax on withdrawals in retirement. The underlying assumption is that your tax rate in retirement will be lower than your rate during your working years. For most Americans, that assumption is defensible. In New York, it carries considerably more risk, and understanding why requires examining how New York specifically treats that money when it comes back out. In 2025, the annual contribution limit for a traditional or Roth 401k is $23,500. For those 50 or older, an additional $7,500 brings the total to $31,000. A provision under the Secure 2.0 Act establishes a higher catch-up contribution for those between 60 and 63, $11,250, raising the total to $34,750. In 2026, the base limit rises to $24,500. The IRS adjusts these figures periodically for inflation. That is the federal framework. New York applies its own rules on the back end. New York State has 9 income tax brackets for the 2025 tax year. Rates range from 4% at the low end to 10.9% at the top. Most middle-income earners in the state pay an effective rate somewhere between 5.5% and 6.85%, according to tax data. The top rate of 10.9% applies only to income above $25 million, so the vast majority of working New Yorkers are not subject to it. Even so, effective rates in the 6 to 8% range place New York among the highest taxed states in the country. That figure reflects only state tax. Residents of New York City, the 5 boroughs, also pay a separate municipal income tax on top of the state rate. City tax rates for 2025 run from 3.078% to 3.876%. depending on income. Combined, a city resident can face a state plus city income tax rate exceeding 14% before any federal liability is factored in. The Tax Foundation ranks New York last among all 50 states for overall tax climate. The state collects $12,506 per capita in state and local taxes. When contributions are made to a traditional 401k, New York follows the federal treatment and allows those contributions to reduce adjusted gross income. The state has its own rules, however, governing how retirement withdrawals are taxed. There is one benefit for retirees. Individuals who are 59 and a half or older may exclude up to $20,000 of retirement income per year from a 401k, an IRA, or a pension from New York State income tax. That exclusion was written into law in 1989. It has not been adjusted since. $20,000 in 1989 represents substantially less real value than it did when the figure was set. For a retiree whose annual 401k distributions exceed $20,000, which is likely for anyone who contributed near the maximum over several decades, every dollar above that threshold is taxed at New York's standard income tax rates, the same rates the account holder was deferring against in the first place. That deferral runs directly into a ceiling that has not moved in more than 35 years. Past it, New York collects income tax on every additional dollar of retirement withdrawal at full ordinary income rates. The promise of the tax-deferred account, pay less later, is only partially honored by the state. Consider a straightforward scenario. Someone who contributes near the annual maximum to a traditional 401k for 30 years with reasonable market returns is likely to accumulate a balance well into the 7 figures. If that account generates a 5% annual distribution in retirement, the withdrawal would exceed $60,000. New York taxes $40,000 of that at full ordinary income rates. That is not a planning failure. It is the direct and predictable consequence of a $20,000 exclusion set in 1989 and never revisited. Federal required minimum distribution rules add a second layer of pressure. At age 73, the IRS requires holders of traditional 401k accounts to begin withdrawing a minimum amount each year, calculated from account balance and IRS life expectancy tables. Failure to take the full distribution results in a 25% excise tax on the shortfall. Under the Secure 2.0 Act, the RMD age will eventually rise to 75 for those born in 1960 or later. But for most current retirees, 73 is the operative threshold. A retiree who spent decades contributing at or near the annual maximum arrives at 73 with a substantial balance. The IRS mandates withdrawals that can easily exceed the $20,000 New York exclusion. The consequences follow in sequence. The excess distribution is subject to New York income tax at standard state and city rates. The increased total income may trigger higher Medicare premium surcharges, which are applied on a tiered income-based schedule, and more of the retiree's Social Security benefits may become federally taxable. Federal law allows up to 85% of Social Security benefits to be included in taxable income, depending on combined income. The New York Bar Association's tax newsletter has noted that required minimum distributions can push retirees into higher tax brackets, raise Medicare costs, and affect Social Security taxability, each consequence compounding the one before. A retiree who saved responsibly for decades faces forced withdrawals on the government schedule, generating income taxed at combined state and city rates that can exceed 14%. There is a second disparity embedded in New York's tax code. Retired government employees, state workers, teachers, municipal employees, and federal retirees receive a full exemption from New York state income tax on their pension income. No cap, no ceiling. The entire pension, regardless of amount, is excluded from state taxation. A private sector worker who built retirement savings in a 401k receives the $20,000 exclusion and nothing beyond it. Both treatments exist under the same state law. The distinction is material, and the two groups face meaningfully different retirement tax outcomes as a result. New York does not tax Social Security benefits at the state level. That is a real advantage for retirees. However, once 401k withdrawals are added to Social Security income, the combination can push total income above the federal thresholds that make Social Security itself taxable at the federal level, up to 85% of the benefit based on combined income. The state leaves Social Security untouched. The federal calculation may not, depending on how much additional retirement income is present. Migration data provides relevant context. According to the U.S. Census Bureau, in 2024, approximately 415,000 people left New York State, while 285,000 moved in, a net loss of roughly 130,000 residents in a single year. United Van Lines reported that 58% of all New York moves in 2025 were outbound, ranking the state second nationally for outmigration that year. In Nassau and Suffolk counties on Long Island, the outbound rate reached 78%. The New York Department of Taxation and Finance reported that nearly 1,700 millionaires changed their legal domicile to another state in 2024, an improvement from the peak of over 3,300 who left in 2020. The Citizens Budget Commission found that between 2019 and 2023, residents who left New York City earned $68 billion more in aggregate than those who moved in. The most common destinations were Florida, which has no state income tax, followed by Texas, North Carolina, and Georgia. The Fiscal Policy Institute, in a December 2024 analysis, offered a counterpoint. High earners leave New York less frequently than working and middle-class residents in non-pandemic years, and departure patterns do not closely track with tax increases. Not all outmigration is tax-driven. Housing costs, family circumstances, and quality of life are significant factors. Residents making financially motivated relocations, however, are moving predominantly to states without income tax. The relevance to retirement planning is direct. If you retire outside New York cannot tax your 401k withdrawals. A retiree who establishes legal domicile in Florida, Texas, or another state with no income tax owes nothing at the state level on those distributions. A retiree who remains in New York City faces the full combined rate on every dollar above the $20,000 exclusion. Most financial advice does not ask which of those situations applies to you. Beyond capturing any available employer match, which nearly always warrants participation regardless of other considerations, several tools are worth evaluating for New York residents who want to reduce exposure to these risks. The Roth 401k carries no income limits for eligibility. Any employee whose plan offers this option may contribute after-tax dollars regardless of income level. The contribution limits are identical to a traditional 401k, $24,500 in 2026. Growth is tax-free, and qualified withdrawals in retirement carry no federal income tax and no New York State income tax. Under the Secure 2.0 Act, Roth 401ks are now also exempt from required minimum distributions for the original account owner, effective 2024. No mandatory withdrawals and no forced taxable events at 73. For high earners who exceed the Roth IRA income phase-out, which begins at $150,000 for single filers in 2025 and eliminates eligibility entirely at $165,000, there is a legal conversion pathway. A contribution of up to $7,000 is made to a traditional IRA, then immediately converted to a Roth IRA. There is no income limit on conversions, only on direct contributions. A more expansive version, sometimes called the Mega Backdoor Roth, involves making after-tax contributions to a 401k beyond the standard employee limit and converting those funds to Roth. This requires a plan that permits after-tax contributions and in-service distributions. Confirmation from the plan administrator is necessary before assuming the option is available. The health savings account is available to anyone enrolled in a qualifying high-deductible health plan. For 2025, contribution limits are $4,300 for individuals and $8,550 for families, with an additional $1,000 for those 55 and older. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. No other account in the federal tax code applies that structure across all three phases. A standard taxable brokerage account lacks the tax advantages of the accounts above, but offers flexibility that tax-deferred accounts do not. There are no penalties for withdrawals before 59.5, no required minimum distributions, and no government-imposed withdrawal schedule. For a retiree who leaves the workforce before the penalty-free window opens on retirement accounts, a brokerage account bridges that gap. It also accommodates assets generating long-term capital gains, which receive preferential federal tax rates. New York taxes capital gains as ordinary income, but the federal preference is real and meaningful. For account holders carrying large traditional IRA or 401k balances before retirement, strategic Roth conversions during lower income years can reduce the eventual size of required minimum distributions and move assets into accounts that New York will not tax in retirement. The tax obligation is incurred at conversion at a rate and timing the account holder controls, rather than at 73 on the IRS's schedule. A portfolio allocation framework used by a number of financial planners targets roughly 40% of retirement assets in tax-deferred accounts, 30% in Roth accounts, and 30% in taxable brokerage assets. That allocation is not codified in law. It is a structural approach to maintaining flexibility across different tax environments and life circumstances, relevant for anyone who may be in New York now, but has not determined where they will retire. One additional tool applies specifically to retirees already in the required minimum distribution years. A qualified charitable distribution allows individuals 70.5 or older to direct up to $108,000 in 2025, rising to $111,000 in 2026 from an IRA directly to a qualifying charitable organization. That amount counts towards satisfying the required minimum distribution for the year without being added to taxable income. For a retiree whose distributions would otherwise push income above the $20,000 New York exclusion, this can keep adjusted gross income lower while still satisfying the IRS withdrawal requirement. The mechanism applies to IRAs only, not to 401k accounts, and is advantageous only for those who intended to make charitable contributions regardless. A bill pending in the New York State Legislature, Senate Bill S2571A, sponsored by Senator Simcha Felder, would incrementally raise the retirement income exclusion to $25,000 in 2027, $30,000 in 2028, $35,000 in 2029, and $40,000 in subsequent years. The bill has passed the state Senate in prior sessions. As of May 2026, it has not been signed into law. The exclusion has remained at $20,000 since 1989, while inflation has substantially reduced its real value. $40,000 if and when the legislation passes, would represent an improvement for many retirees, though it would still fall short of the inflation-adjusted equivalent of $20,000 from 1989. The bill has been introduced, passed one chamber, and stalled more than once. None of the above constitutes advice tailored to any individual financial situation. Tax law is complex and subject to change. The appropriate approach for a 42-year-old employee in Astoria differs from the calculation for a 58-year-old professional in Midtown, a fee-only financial planner, one compensated directly by clients rather than through product commissions, and a tax professional familiar with New York's specific rules are the appropriate resources for individual planning decisions. The standard guidance to maximize traditional 401k contributions without further analysis was not written with New York in mind. It does not account for a $20,000 retirement exclusion unchanged since 1989. It does not address required minimum distributions that can generate taxable income at combined state and city rates exceeding 14%. It does not ask whether the account holder plans to remain in New York or retire elsewhere, and it draws no distinction between a private sector worker subject to the exclusion cap and a government retiree whose pension is fully exempt from state taxation. Geography is a material variable in retirement planning, and for New York residents, particularly those in the city, the standard advice warrants considerably more scrutiny than it typically receives.